Welcome to Royal Destiny Media. Now we want to discuss the rise and fall of US banks, a tale of recent failures of Silvergate Bank and Silicon Valley Bank. The United States banking system has been an integral part of the country's economy for centuries. However, in recent years, we've witnessed the collapse of several prominent banks, causing shockwaves throughout the financial world. And it is important to first consider the incident or the issue of collapse in 2008 before we look at the recent failure of banks in US. In this documentary, we will take a closer look at some of the banks that collapsed, or one or two of the banks that collapsed in 2008, exploring the factors that led to their demise and the impact they had on their customers and the wider economy. So, now looking critically at what we on the economy, investors always entrust their hard-earned income to the banks, and the banks also have that duty of care, that deep responsibility should be there to manage the deposits of the customers profitably so that the customers can have good return for their investments and also continue to profit also from the transaction. So the bank profit from it, the depositors also need to profit from it. So it goes both ways. The banking industry is a highly regulated industry, and talking about regulation in US, finance industry, healthcare industry are in the top rank when it comes to government regulation. Despite this, we still see failures, and the banking regulatory bodies also will need to step in whenever they discover that things are not going right, and in a bid to protect the investments of the customers. Well, like I said earlier, the banking industry is a highly regulated and complex business, and there are a multitude of factors that can contribute to the failure of a bank. Some common factors could include poor risk management, inadequate capital reserves, and over-reliance on short-term funding sources. One of the most high-profile bank failure then in 2008 was the Washington Mutual, which is really shortened as WAMU. So Washington Mutual was a Seattle-based bank with over 300 billion in assets. Yet this bank collapsed. Another one is the IndyMac Bank. So the customers who had been banking with these institutions had no reason to believe that anything will go wrong. But then one day, they tried to withdraw some money from their accounts, and they couldn't. They found out later that the bank had been seized by the federal government. So this is one of the things. This is one of the things that one cannot actually determine as a customer. The customer is helpless in some cases because they don't even know what goes on within these high-rising buildings. So, but the most important thing is that there are regulators in place and they are effective and up to the task to protect the customer's investment. So we've talked about Washington Mutual, WAMU. Another bank that collapsed during the financial crisis of 2008 was IndyMac, a California-based bank with over 32 billion in assets. So that also collapsed. And working at IndyMac, that's one employee now saying working at IndyMac during those last few months was like watching a slow motion train wreck. We knew that the bank was in trouble, but we couldn't do anything about it. It was heartbreaking to see the bank's customer lose their money and their homes. So it affected a lot of people. People lost cars, lost houses because they could not afford to pay their car notes. They could not afford to pay their mortgage. Some businesses collapsed because all their money was in one of those banks, and they could not recoup those the money they've kept in the bank. So they lost a lot of things because of the problem with the bank. The collapse of IndyMac was caused by a combination of factors, including poor risk management, like in the case of the Washington Mutual, and over-reliance on short-term funding source. The bank failure was a stark reminder of the dangers of lax regulatory environment and unchecked greed in the banking industry. And since after 2008, there has been a tighter regulations guiding the operations of banks and the monitoring of their operations as well. The collapse of these banks was a wake-up call for the banking industry and regulators alike. It highlighted the need for stronger oversight and a stricter regulation to prevent similar crises from occurring in future. But now we are experiencing the same thing despite stricter regulations in place. The most recent bank failures involve Silvergate, and another bank. Silvergate, I think deals with banking, cryptocurrency like Bitcoin, and another bank is the Silicon Valley Bank, which also has just been taken over by the regulatory body FDIC. That's the banking insurance company, Federal Deposit Insurance Corporation. And the essence of this is to be able to give the depositors money back instead of allowing the bank operators to continue to go down the valley or go down the south while the hard-earned income of customers continue to go in the lost direction. So let's quickly see what some major newspapers or media houses have talked about this incident. Well, the New York Times of March 8 says Silvergate Capital, a cryptocurrency-focused bank, announced it will close operations and liquidate its assets after a bank run forced the California lender to sell a chunk of his debt securities. Silicon Valley Bank concerned investors when it said it needed to shore up its balance sheet and raise $2 billion in capital. It was forced to sell a bond portfolio at a $1.8 billion loss. So in the letter to customers, Greg Becker, the chief executive of Silicon Valley Bank, said the bank enjoyed the financial position of weather sustained, but he noted that customers' deposits had come in lower than forecast. And the reason for this was the pandemic. During the pandemic, people, the level of request for loan or demand for loan went down at a very high rate, and bank tries by turning out the customers' deposits to those who need loan and taking interest from that. And now that and that period, many people, many investors were just depositing their money. No one wants loan. No one needed loan at that time. So majority of the businesses did not go out for loan. So the banks were short of income because they could not send out the loan as a vehicle to bring in interest. And that since 2019, the banks have been struggling to come back to its feet. And that is not just the issue. Let's look at what the net interest wrote about the demise of Silicon Valley Bank. It says, when banks purchase securities, they are forced to decide upfront whether they intend to hold them to maturity. The decision dictates whether the securities are designated as held to maturity, which is HTM assets, or as available for sale assets. HTM assets are not marked to market. Banks can look on nonchalantly as bonds lose value. They remain glued to balance sheets at amortized costs regardless. By contrast, AFS assets are marked to market, a purer designation, but one that injects an element of volatility into banks' capital base. So for smaller banks, regulators look through this volatility, but for banks with over 700 billion in assets, that volatility directly impacts regulatory capital. So the amount of deposits that they have, the security, how they're able to manage their security within that period, their income was tight, actually affected these banks and their operations, especially Silvergate and Silicon Valley Bank that have been taken over by FDIC in order to protect the deposit of the customers. And looking at Charlotte Observer the Charlotte Observer says, new CEO of failed Silicon Valley Bank was once fired from his Charlotte banking job. The new CEO of failed Silicon Valley Bank is a familiar name to many in Charlotte's banking community. Tim Mayopoulos was fired as general counsel of Bank of America in 2008 in the midst of the financial crisis and escorted out of the office by an HR representative. Could this be a coincidence? So, the FDIC closed Silicon Valley Bank on March 10 and started a new bank called Silicon Valley Bridge Bank. Just like when the 2008 crisis occurred, the FDIC took over Washington Mutual and also IndyMac and ran the bank in order to get the customers' fund back to them. So FDIC is out there to protect certain amounts of customers' deposits so that in case the banks fail, the customers will still have hope, and all hope will not be lost. So this is the brief we're going to discuss today about the current situation of the failed banks in the United States. We do hope that you will subscribe and turn on your notification bell so that when we go live or we upload new video, you'll be notified. Remember to subscribe. Thank you for your time.